For those of you who don't know me, I'm Bill Leitner with ISC Group. I've been around ISC Group for now. In December, I will start my 26th year, and that's just a long-winded way of saying I'm closer to my own retirement. So I'm excited to hear what we talk about today. We have the pleasure of having Kevin Morgan with JP Morgan with this. Kevin is always one of our most requested speakers, and this is one of our most requested presentations that we do. For those of you that are just joining us, this is the fourth in our series of quarterly webinars for this year. So far this year, we've learned about retirement, certainly, but also specifically a presentation on Social Security and on Medicare. Those are all out on our website. If you go to our blog, you can find recordings from all three of our previous quarterly webinars. You know, our goal at ISC Group is to stay with you to and through retirement and to share ideas that we don't always get to share with you when we're on site, and anything we can do to make your retirement easier for you. We encourage you to reach out to us. Grant and I are on the call today. You'll see, a couple other ISC team members jump in periodically. Anything we can do for you, I'll give you our number in case you don't have it handy. It's 800-888-3520. If you have a quick question, you can always reach out to us at info@iscgroup.com. But I know I'm not the star of today's show, so I'm getting ready to turn it over to Kevin. Get ready for a high energy presentation on retirement. A couple of housekeeping notes. Kevin's going to cover a lot, and I know you probably have some questions. So if you will send those to that email address I just gave you, info@iscgroup.com, we're gonna answer those as we can. Anything we don't get answered, we'll certainly email you a response. So with that, Kevin, I appreciate you being here. I'm going to turn it over to you to help enlighten this crowd of folks we got growing. And it's a growing group. I think there's 50 or more folks on so far. So
perfect. Well, thanks, Bill. I appreciate the intro. I don't know who the heck's requested me or who thinks that I'm high energy, but I am. One thing that you mentioned, I'm old. I've been in this business almost 30 years, although, Bill, you need to give me the secret. I've only been at JP for a little over 18 years. How you stayed at ISC for 26 years and have not been fired or have not been written up or maybe like marched down to HR, I got to get the secret sauce there.
But yeah, you know Sheldon from was it Sheldon from Office Space?
Yes.
Sometime I'm going to find out they fixed the glitch.
In the meantime, we'll keep riding the wave and cashing checks, right? But yeah, I appreciate you guys. So my name is Kevin Morgan. I am with JP Morgan. I'm going to let that sink in for just a second and then break your heart, because if I was related to the Morgan family, I would never be doing webinars. So I'm just a regular schmuck. I live out in Trophy Club, Texas, just west of Dallas-Fort Worth Airport. And my pleasure is living in Texas and then covering teams like Bill and Grant, and then helping, deliver this information and this data to their clients. I think the craziest part about the world we live in is you just get so much information, right? Again, not getting to be the old guy again, but in the old days, you'd get your information through the newspaper. You'd get your information through the 6 o'clock news. Now, because of phones and laptops and, now it's on our watch now. I mean, you're just getting a just deluge of information, whether it's good, bad, right, wrong, or indifferent. So when I hear people talk about JP Morgan, the one thing I want to impress upon them is, yes, we're the biggest bank in the world. Yes, we have asset management. Yes, we do investments, target date funds, all that stuff. The most important thing I think JP Morgan does is research and information. And the reason, again, I think that's important is because my job is to make sense of the senseless and to silence the noise that y'all hear. And the reason that is because if we listen to all the headlines and we get caught up in all the BS and the minutia on Facebook or Instagram, or, Lord only knows what other smoking gun, websites you're on or apps you have, you would get so confused. And then you'd have the 3B investment philosophy. And that's bullets, beer, and beans, because we'd all be in a bunker somewhere thinking that the world was about to end. So, Grant, if you can go to that first slide with the economic scorecard. Again, as a researcher, what we try to do is just break things down into simplistic form. So when we think we're going to do a handful of slides on the economy, I told Bill I'd keep this pretty simple. I mean, obviously, you guys know what's going on with the government shutdown, and fingers crossed that'll be over, especially with holiday travel coming up. But if you think about the economy and just kind of break it down into simplistic forms, it's really about growth, jobs, profits, inflation, interest rates, and then where are the risks within that and where are the opportunities within that. I know this typing is small. Even my readers can't read this thing. But basically, if you look at the thumbs, that's kind of how JP Morgan's thought is. And we put this out once a quarter. So when you think about growth, it's kind of sideways, because you guys know things are starting to slow down a little bit. They're kicking around the words like recession and bubbles and busts and all this stuff. So growth has slowed down, although we're going to talk a little bit that it's not nearly as bad as people think. Jobs have obviously started to go a little bit south, and that's why you got a thumbs down there. Unemployment's starting to go up. Job starts and job openings have kind of sealed up a little bit, and wage growth has kind of diminished a little. Profits are kind of sideways. Again, nothing to be alarmed about, but companies' profits are starting to pull back after, these raging AI stories and a lot of the technology booms that have happened with some of these companies within, AI and infrastructure and these data centers. You look at inflation, that's kind of gone down a little bit as well. Whenever people talk about inflation, the big word is tariff, right? And now tariffs, we'll talk a little bit about inflation. It's usually a handful of things. It's always, real estate and rent and housing. It hit our food and gas. That started to mitigate a little bit, but now it's starting to really hit consumer goods again, because of obviously where we get our materials and where we buy our stuff from, made in China, yada, yada, yada. And then we, look, within that, there's always going to be risks. So you look at the inherent risks, the tariffs, market volatility, slowing down the economy. Those are risks. But also within that, there'll be tons of investment opportunities. And you look at that, thinking about fixed income again, now kicking off the income that it's been supposed to do. A lot of stuff with the equity markets where it's broadening and there's more companies than just this magnificent seven where we can invest in and get some opportunity. And then, the government now getting involved, Europe, China, a lot of different things that are happening across the world with geopolitics that, again, depending on how things play out, will open up opportunity as well. So Grant, if you want to go to that next slide. So thinking, just kind of about the economy, we like to break it down into kind of the basic groups, and you'll see the color coordinated. You look at like going into 1Q of 2025, net exports were actually a negative drag on the economy. And a lot of that was because of tariffs and because of the things that happened with, the new president, the new regime coming on. You guys remember all the noise that was happening in the first quarter of the year. But look at how that's flip-flop now coming into the home stretch of 2025. Net exports actually now driving some positive, earnings in the GDP, which is gross domestic product. And then the consumer is light blue, and that's our economist is an Irish guy who I love. He's got a way better accent than me, obviously, but he says you never have to worry about the American economy, because it's full of consumers that like to waste money they don't have on stuff they don't need. So we always have a great no worry about America, because if you're working at home or if you have a Ring doorbell, I'm sure someone's got, a ringer going off because a package has probably been dropped at your house, or your kids ordered DoorDash without telling you. So again, the consumer will continue to drive things for the economy. We go to the next slide, Grant. We talked a little bit about wages. You'll see the black line is the unemployment rate, and you'll see that's actually come down below norms, and it's been sitting there ever since kind of after COVID. We've kind of got people back to work now, and unemployment's been low. It's rising a little bit, but nothing alarming looking at those 50-year averages. Now, what you'll see is there's usually a very inverse relationship between wage growth and employment. And when employment goes up, wage growth usually stays stagnant because there's more jobs and companies don't have to pay for it. As you start to see those two things, connect, that's usually when economic slowdowns happen, and in some cases recession happens. So not saying that we're looking for that, or not saying that it's going to be the end of the world here, but as you can see kind of right now, unemployment and wages, that black and that light blue line, have kind of caught back. And if you look back in time, that's happened during 2020, during COVID, 2022 during when the Ukraine war and all that happened, the great financial crisis in 2008. So you'll see kind of historically what that does, and that's kind of where we're at again. So again, not that history always repeats itself, but everybody knows the joke. It does tend to rhyme. So we'll look and see how that plays out next. Next slide. Profit growth, this is a great slide because we look at all these earnings that are happening, all these companies that we hear about, NVIDIA, Microsoft, Meta, the Mag 7, all these other massive companies, Palantir, Apple Oven, these companies that are making incredible revenue, and the stocks are going just bonkers. We're looking at kind of where that is coming from. If you break down the earnings per share, and for the first time in a long time, the revenue is not driving a lot of that profit growth. So a lot of it is that margin, and that tends to then, if you look on the right side of that chart, slow profits, right? So even though profits have come up after what happened in 2020 after COVID and all that stuff, they spike again, and then they come down, and then they kind of slowly graduate. So that is, again, that profit starts to slow. We don't think the economy's in for bad times, but it's just the slowing growth that we're in. So again, something to be cognizant of. Next slide. And this is just talking about inflation. The two big hot buzzes that we hear about the economy, every time you go in somewhere and they charge you more than you think you should be paying, they all say, hey, don't blame us, it's because of inflation, or don't blame us, it's because of tariffs. And tariffs is the new one that no one even knew what that meant 2 years ago. So we look now, tariffs are starting to bleed in. So you saw, after the Ukraine war in the supply chain back in 2020 and 2022, you saw inflation spike out of control up to 9%. We've gotten it back in range to where it's in that 3 to 3.5, but you're seeing it start to come up again, and it's starting to hit core goods. And we see that's a direct correlation to tariffs. So this is early days in the tariff story. I think, again, our president, he's a lot of bark and maybe not a lot of bite. So we're going to see how this plays out, but definitely something to keep on the lookout about going forward. Next slide. So we hear about interest rates. You saw that the Fed cut back in September, and I think it was the day we did the Texas Public Plan Conference, right, Bill? And I predicted that it was going to be a quarter cut, and lo and behold, 10 minutes after I spoke, they cut a quarter. So I guess now I need to put my Johnny Carson hat for anybody that's old enough, where I could be Nostradamus and start making some bold predictions. I'm not going to do that today, but we'll talk a little bit about, interest rates are always going to be a handful of things, right? The Fed and Jerome Powell, who's the head of the Fed, he has been one thing. He's been totally honest. Everything this guy has said, he's delivered on, and all the things he said need to line up in order for him to do things is going to have to line up. We feel like he got a little bit more pressure in these last two meetings and coming out where they kind of wanted to hold still, but they did these smaller cuts because, again, we've seen an unprecedented rise in rates from 2021 to 2022, where they raised like 5-6 times in a row, and it's unprecedented in the last handful of years. And so now we're seeing that they're starting to pull that back, and we're predicting probably. Look, they're talking about building in another cut in December of another 25 basis points. I'm kind of in the camp, the gospel according to Kevin, that I think they're going to pause and see how things play out, just because what's happening with immigration, now inflation starting to spike again, and we talked a little bit about unemployment and wage growth kind of, starting to mirror each other. So more to come, and we'll see what they say in December, but fingers crossed, and hopefully we can continue to get the rates to come down. Next slide. AI is the talk of the town, right? Is it a bust? Is it a bubble? Is it real? Are we all going to have robots? Are we all going to walk around with virtual reality goggles and never talk to humans again? Look, the reality is on the left side of this chart, these big hyperscalers, i.e. the Mag 7, are continuing to throw billions and billions of dollars into AI. That's all conceptual at this point. They are throwing money at data centers, at ideas that we don't even know will come to fruition or may not, but they have so much money to spend that they're willing to take the risk. And if you see on the right side of that slide, the industries and the sectors that are taking advantage of that, continue to be, semiconductors, computer equipment, communications. But as you can start to see, other sectors are going to start to take advantage of that. Consumer goods, where you guys see now the toll booths now don't have people in them. We go to kiosks, there's not people there when we're buying our coffee. So AI will continue to drive growth in these other sectors. It's just going to be a story that is going to be told over the next handful of years, and not something immediate like the spending that's happening on the left side. So next slide. So when we hear about investing opportunities, it's basically become the S&P 7, right? The only thing everybody wants to talk about is this magnificent 7, because Alphabet, Microsoft, all this stuff, Google, Meta, Nvidia, they're the ones that have just Tesla, more money than they know what to do with, and their stocks have gone crazy. But if you look on the right side, you'll see those numbers have started to slow down. So this S&P 500, the other 493 are saying, hey, don't forget about us. We actually have pretty good business models. We're kicking pretty good earnings, and we're making profits as well. So that's starting to now level out a little bit. And you see the returns on the bottom right side of that chart. Nothing like the returns in 2023 when the best Mag 7 company was up 240% almost. So the best this year to date is about 39%, and they're in that bandwidth where the worst is 24. So nothing, again, we still think there's opportunity there, but I think you need to broaden your horizons and start looking outside the box as opposed to just those same 7. So next slide. And again, talking about opportunities outside the box, this is the first time in a long time the international is actually outperforming America. A lot of this has to do with the Fed over in Europe, the European Council over there. They've started cutting rates. The Bank of Japan has started cutting rates at a more aggressive rate than we have. So their companies, a lot of their value firms over international, have really taken advantage of some of the stuff happening that we don't necessarily hear about every day between New York and LA. So not telling you to go throw all your money into international, but this is one of those D words I talk about. There's 3 D words I want you all to focus on. Diversity is one of them, and this is where we want diversity. Look, the world is bigger than just America, and we need to have our investment opportunities sprinkled around the globe to make sure we're not only mitigating risk, but taking advantage of opportunity. Next slide. This is just a quick one talking about correlations, right? Making sure that you understand that, real estate, transport, and things of that nature, infrastructure, are very highly correlated to a 60-40 portfolio that's stocks and bonds, right? That's more correlated to the S&P 500. Whereas if you look at direct lending, you look at hedge funds, they're more correlated. And then if you look at the left, real estate and that are going to be not as correlated. So this is all about that diversity word to make sure that, where we're investing our money, if you want to go into private equity and you want to go into venture capital, most of those companies, or hedge funds even, most of those investments are going to be highly correlated to public markets because that's what they have access to, as opposed to transport, real estate, infrastructure, where they're doing things that are kind of more off the grid that will be less correlated. Next slide. So people call this the Skittles chart. People call it the eye chart. People call it the crazy chart. This is simply just telling you what exactly I told you about diversity, right? Diversity is the story of that line in the middle where people are investing across the board, not just in large growth, not just in mid growth, not just in Europe. This is more of that 60-40 portfolio where you've got fixed income, you've got a little cash, you got large cap, and that makes the ride of your risk a lot smoother. This is why target date funds were invented into the retirement system, because you're getting a mix of stocks and bonds, and that risk is rolling with you as you get older. Whereas if you look at some of these colors, right, everyone's like, oh, Kevin, real estate's the answer. Look at light blue. It's across the top from 2010, 2011. But then when you look at a 2020, real estate's the worst. No, Kevin, it's all large cap because of NVIDIA and all these big companies, right? Well, large cap is great until it's not, and then it drops, right? You look at a year like 2012, 2022. Those are years where, you don't want to have all your eggs in one basket. So again, that D word of diversity is one of the things we want to really, really focus on. Next slide. So that first chart we showed you that had the thumbs up, thumbs down, thumbs sideways, that's the one I love. If you guys were to print one sheet, just have it in your cube or have it on your fridge every quarter, that would be the one. This is the other slide out of these other slides that I showed that is just the good one, that we give you a key takeaway. here's what's going on. Here's what our thoughts are. Here's where risks and opportunities come to meet. And this is just a great takeaway for you to talk about with the economy. So that's it on the economic update, Bill. Any questions or anything you want to add before I move on to the fun stuff to really scare them?
Yeah, no, scare away.
Okay. Yeah. So again, the good news here, guys and gals, is I would tell you that noise, and that's the other D, right? Dispassion. Stay dispassionate about the noise and focus on the reality. The reality is it's not like, the greatest economy we've ever been in, but it's pretty daggum good. And it's not like, the worst investment environment we've ever been in, but it's pretty daggum good. So I would tell you that right now, cooler heads will prevail, and I would continue to kind of stay the course, be diversified, be dispassionate, and be very disciplined. That's the third D. So let's go to guided retirement, Grant. 4 more slides, I think. So when I talk about research, this is the other piece we put together. And if you look, obviously, on this slide where it's got the reference, it's a lot of stuff. I tell people this is the great big book of everything that you'll need to know from the day you get hired to the day you retire to the day you finally expire. And I know that's a little bit grim, but this is the playbook, right? And again, as you can imagine, from the day you get hired when you're this 20-something-year-old kid, bright-eyed, bushy-tailed like Grant here, to the day you're getting close to retirement like Bill and I, where we're like, let's just get the heck out of here and hope we have enough money to do some of the stuff we want to do. That's a long ride of stuff you have to worry about in between. So we're going to go through this and talk about some of the good, the bad, the ugly. But the greatest thing about this is most of this stuff is things that you can prepare for. It's stuff you can control and things that you can be aware of. You just need to have the discipline to do it. So let's go to the next slide. So just like I talked about, there's some good news, there's some okay news, and there's some bad news. The good news, there's total control of what you spend, what you save, and where you allocate your money and where you put your money. Those are things you have total control of. The kind of okay news is, look, employment, where I work, how long I work, how long I live. I always tell people, if you think you're going to outlive your money, start picking up a couple more bad habits, start smoking, start doing vape pens, drink more. That'll eliminate your life expectancy and you won't have to worry about it. But if you want to have a long life and you want to do all this stuff, remember there are certain things out of your control too. And that's what markets do. Volatility, if anybody thinks you're ever going to live in a market where there's not geopolitical unrest, where there's not busts and bubbles and booms and all this stuff, bulls, bear markets, it's meant to build into the system. There will always be volatility. And then taxes and policy, whether we like it or not, that's out of our control. That's the people that are in government. They're going to whipsaw us around, and that's stuff that's out of our control. So let's think about, next slide, what do we need to really worry about? So the fact of the matter is people are living longer. It's a myriad of a lot of stuff, right? People are trying to be healthier. People are trying to eat better. People try to exercise more. I think it's a combination of that and also healthcare, technology, medication, all this stuff. So what I tell people is no matter what you think that, hey, my lineage tells me I'm not going to live past age 80. I've got a buddy of mine, all the men in his life have never lived past 55. His dad, grandpa, brother, all this stuff, uncles. But you cannot plan for that. You need to think that you're going to live longer. And if we live longer, what do we need more of? Money, right? So always be doing the math on that. Next line. Next slide. The problem with that, everyone thinks because they live longer, well, I'll just work till I die. I'll work till I'm 70, work till I'm 75. Bill and I will be the first to tell you, if we hit the lottery tomorrow, guess what we're doing the day after? We're quitting. We're retiring. It's not, we don't work because, hey, I just love this stuff and I want to be here every day. I mean, look, we enjoy what we do and we like helping people, but if we had enough money and you could live and take care of our lives and our family and our wellness, we'd be C&B on a beach somewhere, right? The problem with people is that they always are in the camp that that happens, but it doesn't happen to me. And this is the greatest example. We polled all these people and said, when do you think you're going to retire? They all said at or after age 65. The reality is only 25 or 28% of people work at or after age 65. And the reasons you'll see on the right, it's a lot of stuff. It's a lot of changes in companies, downsizing, healthcare issues. It's a litany of stuff. If you go to the next slide, there is a lot of older people working in the workforce, but a lot of those people are doing it because they get a little taste of retirement they get bored, or their wife or their husband start to be like, hey, don't you have somewhere to be tomorrow? Like, you're not here again. You were here for breakfast. You were here for lunch. I just want to go take a walk and be by myself. So a lot of people are getting, these 20-hour part-time jobs just for mental health, to buy a little extra. It's certainly not for the benefits or, to subsidize lifestyle. It's more of, just for, hey, I just need somewhere to go for a few hours so that I don't get divorced, and that'll really cost me a lot of money. So if you look the next house or the next slide, a lot of this stuff is having a weird impact, right? Because partially retired households and people that are just getting into retirement are spending a lot of money. And that's coming down to the fact that, I've finally got freedom. My kids are out of the house. I'm at a happy place in my life where I'm not, having to work the 9-to-5 grind. And the problem is things are more expensive. And when you spend a lot, the balances start to go down. So we want to make sure you're cognizant of your spending, because we call it three things at JP Morgan. The age 55 to 65 is go-go. So that's like, hey, I'm 55 between 65. I've got more money than I ever thought I've had with my 401k and some other investments. And I want to be selfish, and I want to do for me. I want to buy the car I want. I want to go on the vacation I want. I want to go to the restaurant I want. I'm ordering steak instead of the freaking salad. I mean, we're going, pop champagne and let it rip. That's go-go years. 65 to 75 is slow-go years, because that's when all your crazy spending now matches up to you retiring. You're not replenishing the bucket with your payroll and your salary, and now it's this obese moment where your balances start to go down, and you really start to worry about outliving your money. So that's the slow-go years. 75 to 85 or 75 and beyond, we call it the no-go years, because that's when that sore knee now needs to be replaced. The sore hip now needs to be replaced. I'm not getting around as much. I don't want to fly. I don't want to do all this stuff. It's a lot of work, and I'm just old and tired, and I want to be in a boat fishing somewhere, or I want to be in a lazy boy watching the game somewhere. So a lot of that changes kind of your perception of things. So if you go to the next slide, what we talk about is making sure you retire to something, not away from something. So the joke I made earlier about Bill and I, if we won the lottery, we'd quit tomorrow. We probably wouldn't do it, because we'd be like, oh my gosh, I have all this money. Now I need to figure out what I need to do. And we need to have a purpose, because otherwise, like what I said earlier, if you're just retiring and you don't have a plan of like what you're going to do with every day, you now have 16 to 18 hours every day where it's just wake up and twiddle your thumbs and be like, what am I going to do today? So we've come up with this acronym called PUSH. And it's basically have a purpose, have a use, socialize, and be out there and be healthy. So again, thinking about not retiring from something, retire to something. Next slide. And if you think, Social Security, again, insert joke here, is going to subsidize it, it won't. So this slide here is showing you the dots at the top that are connecting. That's what the income replacement ratio currently we're thinking you're going to need based on these salary demographics. So people that make $30,000 today are going to need 104% of that in retirement because of inflation, because of lifestyle, because of longevity. So again, not that that's a horrible thing. The good news is if you see the green bar, the people that make 30,000 are actually going to get more subsidized from Social Security, but that blue bar, that 39%, that's on them. So what I tell people, save early, save often, and save more than you ever thought you could. I've got my kids, when I started them way back, I'd give them $1 and I'd only give them 90 cents. And they go, Dad, wait a minute, I thought you said you were giving me $1. I would put 10%, 10 cents aside. I would beat that and ingrain that into everybody you work with, everybody you talk to, because if you look at some of the stats that we see from the University of Chicago and all these retirement studies, they're saying the average employee is going to need to save somewhere near 20%. So at least if we get them saving 10 out the gate, you're at least kind of on the right chart, as opposed to when you start your 401k plan and they auto enroll you in at 3%, you're stuck at 3% unless you do something about it. So beat that into yourself. And again, this is just math on these numbers. So if we look at the next slide, Grant, when I tell people to save more, they just kind of glaze over and don't really understand what that means. When I tell you save more, this is a great chart you can show people. If you make 30, 40, 50 grand, if you go to the next slide, it goes even higher, all the way up to 300,000. All it's doing is basically showing you a graph of if your annual gross savings is 10%, you're in a 60-40 portfolio, your inflation is, 2.5%, and you want to retire at like age 65, this is the money you need to have at that stage of your life. So again, looking at like a 40-year-old that makes $100,000, they should have $200,000 liquid at that stage. Now, again, this is usually when people get torches and pitchforks and start crying and saying, oh my God, I'm screwed, I'm never going to be able to retire. It's not meant to do that. So if you look at the next slide, it's never too late to start saving. Like it's never too late. So this is a slide that we show people that say, hey, I'm not there. What can I do? This is a new slide that shows, hey, that same 40-year-old, if they made 50 grand, they have zero saved today, they need to save at least 18% every year up until retirement. So again, giving you kind of hope. And again, the next slide just goes all the way up to that $300,000 salary. So if you go to the next slide, Grant, on the benefit of saving and investing, this is just common math, guys and gals. If you start saving early and you start saving often, you're going to have a heck of a lot more money. And if you stay invested, like I talked to y'all earlier, stay diversified, stay dispassionate, and stay disciplined. If you do that, you'll be the blue line. The blue line wins the race. This is there's no secret hidden messaging. It's just save early, save often, stay invested. Don't stop your savings. Don't take loans. Don't take withdrawals. Just save your balance. And if you look at the next slide, you'll see how real that plays out. The person that consistently contributed just 3% versus 10% is missing out on almost $1.5 million over a 35-year window. That's real money. Again, this is just math based on these hypos on the right. So again, save early, save often, save disciplined, stay dispassionate. Next slide is just giving a quick breakdown. A lot of people don't understand how the taxation works with all these plans. Hey, what's pre-tax? What's post-tax? What can I get? If I take out, am I going to get hit with tax penalties? Obviously, the best thing you can have is a triple tax saving, and that's through the health savings account. So if you don't have one, maybe talk to your company about trying to get one. And if you do have one, make sure you're working with guys like Grant and Bill and his team to make sure that you're using it right. So many people are using health savings accounts the wrong way. You want to take advantage of the triple tax saving, keep that money in there and not burn through it. And then you can see the after-tax, the Roth, and the pre-tax. Next slide. This is just that diversification we talked about, talking about how the taxes are going to affect. So if you look at that health savings account, the Roth, the taxable accounts, and pre-tax all the way down the line, you'll see how that's going to affect you when you start pulling the money out. The next slide is about Roth. I would tell you, everyone says, hey, we need to have Roth. The government's obsessed with getting our money, guys. So all Roth is doing is basically making you pay the taxes on the front end as opposed to, having tax deferred savings. My take is it's real simple. One, it's a very personal decision for your company and for you. So make sure you're talking to an investment professional before you do anything. But if I'm a 26-year-old like Grant, or he's probably even younger than that, look at him. But if I'm in my lowest tax bracket, why would I not want to pay taxes now? So go ahead and do Roth now. And then when you start to get into the higher tax bracket, that's when you want to really say, oh man, I'd rather not pay that on the front end. So I look at like companies that have a lot of younger employees. You should have Roth as an option just so that they can take advantage of that on the front end so that they don't get hammered on the back end. And then when they take the money out on the back, they're not going to get double taxed on it. So it's kind of a win-win there. The next slide is one of my favorites. So the two slides I showed you on the economic about the thumbs up, thumbs down, and the key takeaway, this is the one I would have on everybody's cube and on every refrigerator because it gives you the playbook on how to save your money. So one, make sure you've got an emergency savings bucket. I work for Chase, so we stock information on everybody. We don't use names, social security numbers, so you're cyber safe. But we look at these stats. Believe it or not, the average client at Chase Bank doesn't have $2,000 in their checking account. That means if we get a hailstorm here or if some knucklehead on their phone bumps into you in the parking lot, that's going to wipe out your savings. So make sure you do your emergency reserves in your bank account or in a brokerage account or an IRA somewhere, and then start going down the line of defined contribution, health saving, paying down your debt. But it gives you a playbook on all this stuff. So I love that. Next slide is just kind of bringing to life that emergency. Oh, I got it up. sorry, next slide is just kind of bringing to life that emergency savings, making sure that you've got at least, 3 to 6 months of a reserve. Sorry, guys, I keep getting the phone calls. And then the next slide just kind of talks about, hey, this doesn't happen to me. It actually does. 9 out of 10 people are experiencing some kind of spending spike, whether it's a roof, healthcare, a car wreck, a water heater, whatever it is. So just be prepared that, you think it won't happen to you, it will. And the next slide just kind of talks about that. When you hit that peak life, midlife is when the stuff happens, right? That's when you have nicer stuff. You have more cars, you got kids driving. You're going to get hit with more expenses as you go through your 40s and 50s. And again, that's when things can really hit hard. Next slide. I talked about loans and withdrawals. Avoid them at all costs if possible. One, they're a nightmare to administrate for your plan, so your company hates these things. Two, they're a nightmare to your balance. They completely devastate your balance. Most people that take loans and withdrawals, then on top of that, shut off their deferrals. So if you can not dig into your 401k balance, don't do it. Try and find some other way to make it happen, because we just see the toxic effects of loans and withdrawals. Next slide. Spending and inflation. Again, everybody gets caught up on inflation. It's the topic du jour. If you look, it spiked in these, these years, but now we're back to kind of overall inflation being right back in line. The things that are always going to be inflatable, that are never going to go away: education, healthcare, that kind of stuff, right? And you see that play out over time. So just be cognizant of that. The next one is just talking about spending. I joke around. Everybody thinks that when you get older, you're going to spend less. I can promise you, when I go back to Ohio and visit my parents, they spend more on dumber stuff than I've ever seen in my life. I go and hang out with my folks, and I'm thinking, well, at least if I'm going to sleep on your pull-out couch as a 50-year-old man, I'm certainly going to get a breakfast cooked. No, we don't really make breakfast, but there's some bran in the freaking cabinet that's dated from 2007. So I try to tell people, you spend more, you just paper cut yourself to death on this spending. And if you think costs and stuff is going to go down, you see here, it actually doesn't. And in fact, you're spending more because now you're spending more on healthcare and insurance and things of that nature that you're not maybe paying for when you're in your 40s and 50s. So be cognizant of that. And then 2 slides, actually go 3 slides. The thing that I love about this is, when you have more money, you're more confident. And when you're more confident, you're smarter about your spending. The thing you don't want is like that go-go, no-go, slow-go and all that I told you. You don't want to live your life in go-go, because at some point you're going to have that beep moment where you look. So you want to be thoughtful about your spending and make sure that you're working with professionals, make sure that you're diversified, make sure that your accounts are, and also putting your lifestyle into play. When we talk about people, and do all these charts, we ask 100 people, what do you want to do in retirement? Most times we just get blank stares. They're just caught in, what am I making for dinner? Who's picking the kids up? Is the dog out? Did I leave the iron on? All this stuff that we think about, we need to be cognizant about what we're going to spend in retirement. So, and if you look, the 2 more slides, Grant, the 4% rule, our business does a terrible job because it's the average participant. It's the average withdrawal. It's the average projected outcome. Our industry used to tell people, hey, when you retire, you're going to pull about 4% out of your, every time you go in, you're going to pull 4%. The problem is when you do that, you would last, right? The problem we talked about is these spending spikes, and people start to pull 5, 6. The account balance disappears when you start to spend more. Again, specifically, if you're not invested, a lot of people want to get more conservative with their investments as they get older. If they do that and they spend more, the money disappears at an alarming rate. So again, just be super cognizant of making sure you have a long-term plan, make sure that you're still invested, that you still have some risk on the table, because I can promise you, the minute the checks from your company stop showing up, you're going to be alarmed at how quickly that money starts to disappear. Let's go 4 more slides up to the one that says taking risk gets harder with age. So this is what I talked about. People are always tell you that, hey, it's not going to happen to me. It's fine. The one thing I know about people is they don't change. Back in the ice ages, when there was 2 cavemen and they looked at a bunch of saber-toothed tigers, they didn't look at those tigers and say, these tigers are probably vegetarians, so let's not run. No, they see a tiger and they run. And that's the same thing we do now, right? We're human. We have these built-in, the good, the bad, and the ugly that, unfortunately, this original sin that we were born with. And that's sometimes good and it's sometimes bad. A lot of times with risk, it's bad because people think, I can't take risk. I can't be in the market. I'm going to miss out. Let me put all my money in cash. Well, I can promise y'all, if anybody's been sitting in cash since 2022, they've missed out on about 400% returns. And that's something you can't replicate ever again. And the one thing you don't get a lot of time, right? The timing might be wrong, but over time, you have to get it right. So again, be thoughtful of that. And then consider your retirement goals. If you go one more slide, Grant, it's the difference of, just, hey, I want to have enough money to pay my bills. I've got my debt paid down. I don't want to get crazy. If you go to the green in the middle of that triangle, well, I'm kind of selfish. I got my debt paid down. I still want to live a little bit. Now I got to have a little bit more with, some different type of investments. And then if you go to the top and you actually want to leave something behind so that the minute you are in the pine box, your account doesn't go to zero and you actually have something to leave your kids or your family, you have to be thinking about growth-oriented portfolios. So working with a professional about how you invest is going to be very, very important, specifically when you get into your golden years. So if we go, let's go to goal-based wealth management. Yep, right there. So here's the thing when I talk to people about risk, right? I told you guys volatility is part of it. You're always going to go through this stuff. You look at these 1 year numbers. So in the blue chart, the best 1 year of equities, and again, this is since 1950. Markets were up 52% in equity. The worst year, 37%. That is a wild ride at Six Flags, guys. So I would tell you, yeah, that sucks. That's crazy, right? I would never want to be invested in all that. But if we look out to a 5 year, again, talking about that discipline, that same dispersion between up 52 and down 37 in the same bucket of equities, up 29, worst 5 year rolling was down 2. So again, we never want to lose money, but that's a way bigger story of difference than, up 50, down 35. You go to 10 years, up 20, the worst is down 1. And if we go to 20, which, oh, by the way, is what a retirement plan and a 401k is supposed to be, because you're supposed to start it in your 20s and get there for 40 years, never lost money in equities. And by the way, look at bonds, 50-50, all this stuff. If we stay disciplined over a 20-year rolling window, it never loses money. So keep your investments in your plan, keep them very diversified, stay disciplined, and stay dispassionate to the noise that you're hearing. And if you go to the next slide, this is kind of what I'll wrap it up, and this brings it home. This is when I talk to people that are the smartest people on the planet. Hey, Kevin, I knew that 2008 was coming. I pulled all my money out, put it in cash. Oh, Kevin, I knew the great financial, I knew that these subprime loans were happening. I knew that COVID was happening. I mean, these people are amazing how they know all this stuff is happening, but yet they never tell us about it, or they're on some weird blog and no one knows about it anyway. But anyway, here's the thing. From 2005 to 2024, if you were fully invested, and again, this is just the S&P, so $10,000 fully invested, you walk away with 71 grand. So again, nothing that's going to change your life, nothing that's going to be like, oh my gosh, I can retire. But if you just missed in that 20-year window, 10 days. So think about it, in 20 years, you just missed the 10 best days, your return dropped in half. If you missed the 20 best days, because I can promise you, all the people that know everything and pull their money out and go into cash, they sit in cash and they miss all the upside. The best 20, you lose another half. So that same 10 grand, instead of making 70, you're down to making 19. This is where I talk about dispassion. And if you look at the little bar in the middle or the box in the middle, 7 of the 10 best days occur within 2 weeks of the 10 worst days. So that tells you that if you get nervous and if you get freaked out and you pull your money, 9 times out of 10, or gosh, 99% of the time, you're going to miss all the pullback on that rubber band. So stay disciplined, dispassionate, and diversified, and I promise you guys, you're going to be fine. That's all I got, Bill. There's some stuff on Social Security. This deck is for everybody to use, but I know you guys have done some of that other stuff, but this is meant to just tell people Don't think it won't happen to you, because sooner or later, everything happens to us. Don't be unprepared, because all of this stuff is something you can control and prepare for, and work with a professional like the ISC Group and let them help you, and let us help make it easy for you, because it is a gauntlet, but it's not one that we can't fix together. So
yeah, hey,
that's all I got.
thanks, Kevin. Great stuff. And thanks for the recommendation to work with us. That's what we're here for, is, by virtue of being your retirement plan advisor, we're here for you. We tell folks we're on retainer for you to answer all your financial questions. So I hope you'll reach out to us. I would say a couple of things towards what Kevin mentioned, and I learned something today, which was never place a bet with Kevin, because you're only going to get paid 9 cents on the or 90 cents on the dollar. So there's one. But he shared a lot of good information. Mannix, Melissa, Grant, Scott, we all have a copy of those charts that Kevin shared with you. So if we're on site, or you want to see, hey, what should I have saved for retirement, or what's my percentage savings rate, we can share those with you. Send us an email at info@iscgroup.com. Catch us when we're out on site at one of your locations. If you have a question, Mannix, Melissa, and I, Scott, we're out and about a lot, but Grant's in the office and dying to help you out. So please use us as a resource. Reach out, and let us know if there's anything we can do for you, because we are here to make retirement easier for you to get the retirement that you want and deserve. So appreciate you spending some time with us today. Kevin, I didn't have any questions, so if some come in, we'll send them your way. And if you're out there listening and you think of something, send us the email at info@iscgroup.com, and we will follow up with you. Thank you again, Kevin. Thank you, everybody, for your time.
Appreciate you guys. Holler if anything comes up.
You.
See you.